Today we have something a little different for you. Check out this Encore episode that we think you will enjoy.
You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, and welcome to the Infinite Banking Mastery Podcast. Today's lesson is about compounding interest and the magic of it being uninterrupted. But before I jump into the topic of today, I wanted to touch on the whole thing with the Silicon Valley Bank collapse that happened March 10th. Because of course, how could I not say anything? I'm sure you've all heard about it and been talking about it until you're blue in the face by now. But I just wanted to say a few things. For one, as I'm sure you've heard, this was the 16th largest bank in the U.S. and the largest bank failure since Washington Mutual in 2008. Yikes. Not good times to think back on, that's for sure. Well, FDIC, as I'm sure you know, swooped in right away and stated that all deposits up to $250,000 were protected and would be available to depositors by March 13th. When I first read this about this catastrophic event on March 11th, I decided to look up information right away that was put out directly from the FDIC. So I pulled up their press release about it, and I'm going to read this small paragraph that's quoted right out of the FDIC's press release. It says, "The FDIC will pay uninsured depositors an advanced dividend within the next week. Uninsured depositors will receive a receivership certificate for the remaining amount of their uninsured funds. As the FDIC sells the assets of Silicon Valley Bank, future dividend payments may be made to uninsured depositors." Now, this is exactly how the next bank bailout was to occur, as written in the new Dodd-Frank Act, the law that was passed in 2010 after the 2008 crisis. This law was written to prevent future government bailouts of banks. That law stated that rather than the government bailing out banks, it would be the unsecured creditors of that bank that's doing the bailing out. And as I mentioned in my earlier podcast on fractional reserve banking, where I spoke a little bit about all of this, we are the unsecured creditors. Now, since this first happened, they have decided not to follow through on this new law and instead find a way to skirt the law. The Federal Reserve has put itself in a position of nothing but bad options, but they are doing their best to keep people's confidence in the banking system high because, of course, they don't want another run on any more banks. They don't want all of you rushing off to your bank and taking all your money out, so they are trying to keep confidence high. And of course, really, that's not a good idea to everybody rush off to the bank and take their money out because then that will cause a catastrophic event. But you can protect your savings. But just to clarify this press release that was first given by the FDIC, let me explain what they said, just break it down. So the uninsured depositors that the FDIC is referring to are those with over $250,000 in their bank accounts. So they're just talking about the funds that are over $250,000. They stated that these are those people with the uninsured deposits would be receiving a dividend within the week. Those depositors were also going to be receiving a receivership certificate, like an IOU. For the cherry on top, they were told that they might receive future dividend payments as the assets of the bank were sold. So they were supposed to get some sort of dividend or payment rather than all their money. Then a certificate, an IOU, and then maybe some dividends in the future. Now, if that doesn't sound like a good deal, I don't know what does. Luckily for these bank customers, they will instead have access, or they do instead right now, have access to all their cash. And at least that's the news as of today. So I just want you to think about it. The FDIC, and how safe does it really sound? because the only way FDIC gets the money to insure your deposits in the first place is, drumroll please, by taxing you. And don't forget that the FDIC has less than 1% in reserves for all those deposits that they're insuring for all of those different banks. So again, whether the Federal Reserve might jump in to save the day or not, causing us, the taxpayer, more pain later, this is just one of the reasons why I house my savings dollars in whole life contracts with companies that have been standing for over 100 years and that do not practice fractional reserve banking. There have been 562 bank failures since 2001, but not one person has lost a single dollar inside of a whole life contract, ever. Unless, of course, they made poor choices and ruined their own contract. A failing life insurance company almost never happens, but when it has, another company has swooped in to purchase the assets of the failing life insurance company. And guess what? The life insurance contracts, your contracts, are the assets of the company. Now, I think I've digressed off the topic of this podcast for long enough, so let's move on to the topic of compounding interest. Albert Einstein, he had some things to say about compounding interest. He said, "The strongest force in the universe is compound interest." He also said, "Compound interest is the eighth wonder of the world. He who understands it, earns it, and he who doesn't, pays it." This is a topic that most people, I'm sure, feel they understand. I just want to really shed some more light on the power of continuously compounding interest. Compound interest is earning interest on top of your principal that you started with and the interest that you've already earned. So for example, if you were to start with a principal amount of, say, $1,000, and you have an interest rate of 4%, next year your total would be $1,040 because you earned the 4%. And so the next year, you would be earning the 4% interest on your new total of $1,040. So it'd be growing, you'd be growing interest on top of interest, and it would start to stockpile and start to roll like a snowball and just start collecting and getting bigger and bigger as it grows because you're earning interest on top of interest, not just the 1,000 that you started with. So I'm going to tell you a little story to help get this picture across better. The story of the penny. And so, I don't know, many of you may have heard this. Sometimes when I'm talking to new clients, they're saying, "Oh yeah, I've heard of that example before. I'm sure it's out there. A lot of people are saying it." I'm just going to give you my version of the story of the penny, just so that you can understand what I mean by this magic of compounding interest. So let's just say you were receiving a 30-day job. Someone wants to hire you for 30 days, and they're going to give you two payment options. You can either earn $100,000 a day for 30 days, or you could earn 1 cent that doubles every day for 30 days. This is where I ask my clients, which would you choose? The $100,000 for 30 days or the 1 cent that doubles every day for 30 days? You know, people realize it's a trick question most times, but every so often somebody will say, well, $100,000 for 30 days, that sounds pretty good. And it is good. For 30 days, that would end up being $3 million. Terrific. Now, the penny that doubled every day, had we selected that option, which is the right option to select, might I add, you would end up being at $10,737,418 at the end of 30 days. And now that seems astronomical. How did it get so big? If we think about it, it was really the last week where it got so large because, you know, the day before it was more like 5.3, and the day before that it was like 2.6, or, you know, it was just less and less each day. So it was that last week that really it exploded into this 10,737,000. But then, you know, this is a job. So what about the tax? You know, we're going to be taxed at our job, of course. So if I use a tax bracket of 30%, and we're being taxed this money, and I'll ask, how much lower do you think that $10 million would become? Well, if you're being taxed 30% every day it's really going to take some damage to the doubling effect. So that $10 million at the end of 30 days becomes $81,935. Whoa, can you believe it? It's quite a lot lower. And so what I like to explain that this represents is having any account that earns compounding interest that you have, but you have to interrupt it, whether it's for taxes or for vacation funds or a new car or for any reason. If you have an account and it's earning this compounding interest and you have to go in there and get the money out for some other purpose, you are interrupting this magic of compounding interest. So what happens when you interrupt it? As you can see, it has a devastating effect to the end result. We went from 10,737,000 to 81,935 because of having to interrupt that compounding interest. And so that's why I'm trying to explain to my clients that you really, who doesn't want picture number one? Where are we getting doubling? Nobody's getting double the amount of interest every day, but you get the idea. So understanding compound interest is important when talking about whole life policies because these policies have the power of uninterrupted compounding interest, like the first example, like the penny that was uninterrupted in the first example I gave you without the taxes. And so you're able to grow your policy, you're funding your policy, it's growing. And if it's a mutual company, you're earning dividends into that as well, which is making the snowball bigger as it's earning this compounding interest year after year. And then when you're ready to use the money, if you need it for something, maybe you want to pay off some debt, maybe you have another need, another investment you want to go out and invest in, or maybe you want to buy some real estate. But then you're able to go in and borrow against this value in your whole life contract. So your value remains untouched. It is the same. It is the same as if you never borrowed any money. So let's just say you have $100,000 in there and you want to go out and you want to borrow $100,000 because you want to put a down payment on a couple of houses. You want some rental properties. Well, your $100,000 continues to grow with the interest and dividends that the company is giving you as though you never touched the money because you didn't touch the money. You're using that money as collateral and you're able to borrow against it. You're able to borrow the life insurance company's money. And so that's why I like to use this example because it illustrates how powerful that compounding interest is when it's not interrupted. And that's what happens in your policy. It just keeps getting bigger and bigger. And the interest year after year keeps piling in and it begins to snowball and just get this bigger and bigger snowball until the end. And of course, the closer you get in your older years and your older age, closer you get to retirement and all that, depending on when you started your contract, the longer you have it, the better the compounding at the end. So it's earning more and more in the later years. So you want to start your contracts as soon as you can, as soon as you are able to, because the time is what's your best friend. Time is your greatest asset. And so you want that time to be on your side, to be able to allow for those years to grow and year after year have this compound interest magic happen on your contract, because when you're 65, 70, 75, it's just growing so well. And then you're able to access that money in your retirement years, tax-free, just as you were all throughout your life when you were borrowing against it to finance different things, get different cash flows going, finance things that create more passive income so that you have different ways to be earning cash flow and income beyond just your life insurance policy. And in the meantime, while you are funding your policy, it's growing, it's compounding, you're just growing this snowball of cash. In the meantime, while you're doing that in hopes to use that in retirement, get those tax-free withdrawals in retirement, you at the same time are receiving other benefits inside of your policy, not just the benefits of being able to finance the next thing you want, next thing you might want or need, or maybe you want to pay off some debt or again, invest in property or something. At the same time, while you're working towards all of that, you are also receiving other benefits, like there's a benefit for, and I'd mentioned this before, where if you become critically, chronically, or terminally ill, you can access a portion of the death benefit of your contract. And at the same time, again, it's building a legacy for your loved ones, for your future loved ones when you finally do pass or graduate. it will be left to your loved ones. So you're able to hit all these birds with one stone, and you're not having to choose, well, I think I'll fund whole life, or I think I'll fund this other investment. You can do both. This is just a funding vehicle to house savings dollars so that if there's a bank crash, you don't lose all your money. And at the same time, your money's doing more for you. You have this access to this larger death benefit if something happens to you. And you also are building this legacy for your family. And so it's doing a lot more things for you than just leaving it in a bank and letting it sit there. And so mentioning that, one thing to note is that when it comes to infinite banking, it's not all about the compounding interest, even though that is really awesome. But even more so, it's about keeping your money in motion, like the banks do. And so that's what we're going to be going over next time. I'm going to be discussing what this means to keep your money in motion and not just letting it sit. Until then, if you would like to learn how a policy could work for you, please reach out to Valerie at alphaomegawealth.com. I would love to chat with you. Have a great week.
This is thepodcastfactory.com.